Welcome back to Morning Trade Live. U.S. stock futures are down, but a lot more for the Russell and the NASDAQ. Let's bring in Edison Byzyka, Chief Investment Officer at Credent Wealth Management. Edison, welcome back to the show.
Hi, Oliver. Welcome.
Appreciate you being here as always. Next week, we've got a Fed meeting, and it seems like folks are hoping for something different than the hawkish tone that it seemed like we were getting a couple weeks ago. Is that the right way to think about it?
You know, I really don't know what to think about it anymore in such a short time frame. The way we kind of talk about the Fed in this context here internally to clients is, I think pausing their hiking process here, Oliver, I think is a mistake in the short term. There's a lot of noise out there, a lot of things happening in the financial side of things on the banking sector. Them being hawkish at this point in time, to some extent, deserves a lot of merit. Inflation isn't going away. We're still seeing pressures on that front. Being hawkish does have value in this context, but I think they're going to lean the other way here at this next meeting. And I'm not sure that's going to be the right short-term move.
Is that why we're getting such a big difference between tech companies and the rest of the market right now? Gains in Bitcoin, gold at the same time?
Absolutely. You know, I tracking kind of, you were talking about the Russell 2000 relative to the NASDAQ. And, you know, through the first 2 months of the year, January and February, almost linear relationship between the two, right? Both positive, double digits. It is now the past 2 weeks with kind of what we're seeing happening in the markets from a macro and kind of current event standpoint, that spread has widened to nearly 900 basis points between those two. And I think it is the market kind of gauging and saying, okay, the dovish stance is going to be very dominant at this point in time. Risk assets have gained value on that front. But I think it is the wrong move. I think it might be short-lived in the fact that I would hate to see risk assets really gain a lot of value and momentum in this point in time, just for the Fed to come back even a month from now to say, you know what, we're going to continue our hiking process and maybe 50 bips is back on the table. I think that's going to cause even more uncertainty than simply keeping a tone of maybe not 50 bips this time, but 25 basis points still holds merit because, you know, we're not living in a monodimensional kind of concept here, right? If the Fed was looking at just inflation, the appropriate answer would be to not stop rate hikes. I think the other noise that's being baked in, that's where it's very difficult to quantify the decision-making process that the Fed is kind of taking on right now, Oliver.
I like that. Well said. And it's in, what about the areas that are really under pressure right now, like the banks? Is that, and we also saw energy yesterday too, so it does seem there is kind of a wider economic concern seeping into the market beyond just the specific banks that are under the most stress. Are these areas that are presenting opportunity for investors, or should they also be avoided until we find out really whether or not the situation's worst has passed?
Yeah, we're taking a look at that kind of two different ways. First and foremost, I think accepting that idiosyncratic risk in the largest banks, I think those do provide value as of right now, right? So your systemically important financial institutions, your JP Morgans, Bank of America of the world, right? I think those individual names do pose value for kind of a long to medium to long-term investor. On the other side of the coin here, right, looking at what has been perceived here as tremendous value being created, a lot of regional banking stocks, a lot of small cap stocks, even mid cap stock segment, I would be very careful in accepting individual equity risk within those segments. That doesn't mean that's not a good idea. So the best way to explore that, kind of how we're exploring that space very carefully, is taking the ETF route, right? Regional banking ETFs have seen tremendous downside. And accepting that kind of systemic risk from that standpoint, as opposed to the individual equity risk, at least for right now, does pose some tremendous value. I think long-term investors could certainly benefit from that. I think the downside has been tremendously impacted by sentiment, unfortunate sentiment that is. I think there's a lot of noise that hasn't been justified from a true crisis, right? Unlike what we saw in 2007 or periods before that. So yeah, tremendous value in those names, but be careful on the underlying smaller banks. The larger ones, larger names do pose tremendous value, I think, for over the next 12 months. Stick with ETFs on the regional side as that play into the banking sector from the smaller cap side.
Do you think we are going to get new regulations or major legislative response to what's happened here? And how does that potentially alter the outcome for some of these banks?
I think regulation is going to be a big hot topic here, right? It could be political in nature, right? There are campaigns coming down the road here for various political parties, or it could be legitimate. One thing that I think is going to get tremendous scrutiny is, how did something like Silicon Valley Bank fail, right? Given the added scrutiny, given the Dodd-Frank components, given what was, the lesson disclosures and the laws that were revised back in 2018. I think all that's going to naturally come into the mix. But if you were to truly kind of dissect the political, kind of the policy standpoint of what needs adjusted to make sure the banking system is safer moving forward, there's not going to be much different there, right? The banking system is, in fact, very liquid. Banks have been well run. Regulation has worked extremely well since 2018. And I think we're just working through some of the kinks right now, mainly from a sentiment standpoint, as opposed to a true kind of fundamental issue, Oliver.
I think people still just kind of have some lingering anxieties and sensitivity around banks. I mean, we have seen other companies the last year really buckle under interest rates, plenty of tech stocks. Some companies that just debuted a few years ago have already seemed to have gone by the wayside. Is this just kind of part of that? And we have a sensitivity around banks, or given their nature as banks, should we have a higher sensitivity?
Maybe. I'm going to give you that answer. Here's why. I think the fact that interest rates are rising and we're seeing businesses collapse, right? And it's not just banks that are going under at times, right? There's non-financial companies that are actually feeling the pain as well. Let's first recognize the fact that under this capitalistic economy that we all live in, that is a normal part of the process first and foremost. I think hearing of a failure in any business, right? The first response is, how could the government have helped that be better? The reality is maybe they shouldn't have, or they couldn't have. So that's first and foremost on that front. I think that's part of kind of being in the economy and running a business and the risk associated with that. Secondly, as it relates to being more sensitive to the banking sector, I think the global financial crisis did leave scars, lasting scars rather, right? That what we experienced just, roughly in 2008, 2009 is going to happen again. The policy and the components that were put in place to avoid that have been substantially beneficial over the past 15 years. And the sensitivity of it, though, is not going to go away. So that is, you're absolutely right on the sensitivity of because it's a bank stock and their impact to everything else that we do in the economy. I think the sensitivity is there. But as far as the risk associated with it, I think things are maybe overplayed as of right now from a sentiment standpoint.
Edison, well said, is the Treasury and bond side of this at least going to start to normalize? Investors seem to be buying Treasuries to hedge right now when they're concerned about economic risk. Does that at least provide some relief compared to last year when stocks and bonds were selling off together?
I think that is going to be a difference this year, but but just partially, right? I'd love to say that going long duration right now is going to be a great safe haven. Yet that may pan out for the next 2 or 3 weeks until, again, the Fed does turn a little more hawkish again. Bonds, I don't think are going to have as worse year as last year, right? That correlation was high and they're both down. To see bonds in negative double-digit returns last year was rather unprecedented. One of the things we did, Oliver, is kind of went back and said, okay, where have we seen even the 2-10 spread at these levels before? And, you got to go back to the 70s and 80s. And as rates do start to normalize to some capacity, and normalization is not them going super low. It's essentially starting to be neutral, starting to be steady, right? So maybe we see the Fed funds rate between 3.5% to 5%. Under that environment, you start to see the bond market really start to provide value again. We're not quite there yet, but I would envision over the next 6 to 12 months, we see a better path for kind of duration-based expectations, kind of how managers should position themselves for the eventual value add from the bond market again.
All right. Really good chat. Good start to our show, and great to catch up. Thanks, Edison.
Appreciate it. Thanks, Oliver.
All right. We covered a lot. Chief Investment Officer at Credent Wealth Management.